Out of 100 people who start trading today, only about 10 will still have an active account a few years from now. The other 90 get pulled under. What exactly separates those 10 survivors from the rest? Most beginners arrive expecting a quick path to wealth, armed with flashy indicators they bought from online gurus. The reality is a fast, clinical drain on their capital. The mechanism responsible for most of these wipeouts is leverage. Leverage allows you to control a large position with a small amount of money. Because of that magnification, a price moving against you by just a fraction of a percent can liquidate your entire account. Faced with that kind of pressure, the 90% rely on emotion. They consume financial news and try to predict what the market will do next based on what they think should happen. The 10% who survive use a different approach. They rely on the clinical framework outlined in John J. Murphy's Technical Analysis of the Financial Markets. Surviving the chaos requires abandoning guesswork completely. Instead, successful traders align their decisions with 3 physical laws of price movement. This text lays out the foundation. Market action discounts everything. This means fundamental data, political news, and human emotion are already reflected in the current price. If a stock is rising, demand exceeds supply. The underlying reasons don't matter. Beginners drain their accounts fighting this reality. They read a negative earnings report, shorting it, only to watch it climb higher because they argue with the tape. That leads to the second premise. Prices move in trends. Built on Dow theory, a trend in motion is highly likely to continue. It maintains its momentum until a definitive reversal signal is confirmed. Undisciplined traders step onto the tracks, trying to pick the exact top of a rally or catch a falling asset at its lowest point, rather than simply riding the established direction. The final premise is that history repeats itself. Chart patterns have worked for over a century and continue to work today because they are visual records of human psychology. Human responses to fear and greed rarely change. The market exploits these predictable reactions. It triggers deep panic near the bottom, forcing people to sell, and induces intense fear of missing out near the top, tricking them into buying at the worst possible moment. Without a clinical system, traders take a loss, get angry, and immediately enter a revenge trade to win the money back, abandoning all logic. You stop acting like a gambler, hoping for a lucky break, and start operating as a technician, executing on strict probability. Let's look at how this plays out on an actual chart when evaluating an asset in a clear daily uptrend. This diagram illustrates support and resistance. Rising prices form a zigzag of peaks and troughs. Troughs act as support, a floor where buying interest overcomes selling pressure. Peaks act as resistance, a ceiling where sellers force the price down. The beginner trap usually happens right at that ceiling. Seeing the price surge, the undisciplined trader gives in to FOMO and buys exactly at resistance. Almost instantly, selling pressure kicks in, the price retreats to the support floor, and the trader takes a loss. Eventually, the underlying buying pressure builds enough to shatter that resistance ceiling, pushing the price into entirely new territory. This chart illustrates role reversal. When a resistance ceiling is decisively broken, it transforms into a new support floor. Disciplined technicians don't chase the breakout. They wait for price to drop and test this new support to control their risk. The survival framework comes down to a few strict rules. Manage your leverage. Never risk more than 1 to 2% of your total capital on a single position, and only trade in the direction of the established trend. The goal isn't to hit a massive home run on one lucky guess. The goal is capital preservation and steady consistency over hundreds of trades. The market doesn't reward intelligence alone. It rewards discipline, patience, and risk management. That's why only 10% of traders stay profitable over time. To dive deeper into these mechanics, join us in our next breakdown. What is technical analysis? The foundation every trader must know.